Well, let's analyse not just the ceasefire in this tariff war, but also the market reaction itself. Matt Sherwood is the head of investment strategy at Perpetual and joins me now. Matt, first up, do you imagine that the volatility that we've seen, big collapses in markets, big rises that we've seen overnight, do you think they're behind us?
Well, I think the market believes they're behind us because the market believes that the trade war, or the worst news of the trade war now, is pretty much known. And what we have seen is a very fast drop in US share prices in March and April. And then on the 8th of April, President Trump blinked and we've had this incredible rally in 5 weeks. The US market's up 17% in 5 weeks, and we haven't seen those sorts of gains really since the second quarter of 2020. And this is all, very V-shaped, very large decline, very fast recovery. And really the key for investors is what happens next. And that really is probably the great unknown at this stage.
So this is the real issue here now, is trying to work out as an investor whether the earnings of companies are keeping up with these share prices. Because in many cases, you'd have to say that the tariffs, and we're going to see inflation out of the United States tonight, that'll show that already prices will have been rising in America. And the question is whether, in fact, the profits have kept up with these share prices.
Yeah, I think one of the big challenges at the moment with the tariffs is, how much of this is actually going to have to be absorbed by the companies themselves. Now, they're sitting on pretty good margins. The current reporting season, which is nearly over, has seen the big theme out of that was rising margins. And it's pretty clear that firms are going to have to digest some of these tax increases, because this is not like 2020. Where there were huge stimulus checks given and savings went through the roof. US savings are now very anemic, and consumers are just not in a position to be able to digest a fairly substantial increase in US inflation. So corporates are going to have to come in and cushion some of this impact. And of course, earnings expectations haven't really declined recently. So people tend to think that it's back to business as usual, but I'm certainly not convinced of that.
So Matt, the one thing that is highly unusual to me, at least anyway, is the market reaction. So the market reaction, even today and last night in the United States, really was an exaggeration in many ways of what took place, as it was when markets collapsed at the outset. Now, my gut feel is, in many ways, this is short sellers having to cover their positions and therefore buy back into the market, pushing up prices. And the second thing is index funds, so exchange-traded funds and index funds, effectively also having to chase the markets, so pouring many, many tens and hundreds of billions of dollars into the stock market, chasing prices that are rising.
Yeah, I think there's definitely something in that, Ross, because when you have systematic momentum trading every day on the back of ETFs and passive funds, what it really does is amplify the trend that is already there. So using the benchmark as a barometer for investment merit, I think, can distort markets by concentrating capital in large companies, and that can positively reinforce overvaluations and thereby increase systemic risk. Now, of course, the regulators look at the market and think the benchmark is riskless, but I believe when markets are so richly priced at the moment, the US market went through a correction, but it's already back to 91st percentile valuations relative to the past 20 years. That's in the US, and Australia's even more expensive at 94th percentile. So when I look at that, and passive funds engage in this systematic momentum trading every day, it really does amplify market risks, and in our portfolios, we try to address this by, getting away from benchmarks as a way of managing and reducing portfolio risks. But to me, these trends are really exaggerated by the structure of the market.
So just explain that chart we saw up a little while ago, which was about drawdowns. What does that mean? And what does that say about the risk inside markets and the volatility?
Well, at the moment, what it shows is the blue bars show the maximum drawdown we had, which was really from the peaks in markets in either February and March to the 8th of April. That's when President Trump blinked. And what we can see is that most markets now have rallied back pretty strongly. In fact, there's only 3 markets now, or 3 indices here, which are still more than 5% below their peak, and that is Japan, that is the Nasdaq, and that is US small caps. Now, in some ways, they may offer some opportunities for investments because they haven't recovered as quickly. But the challenge to me today, really, what that really highlights is that there's no time now to go bottom fishing. The markets have recovered too quickly. And as a result, what we really have to hope for this market rally to extend is that President Trump changes the narrative away from tariffs and towards market-friendly things like tax cuts and deregulation. That could keep the market rally going, but there's still a lot of tax increases to stomach.
I'll tell you what, Matt Sherwood from Perpetual, always good to have in the program. I'd suggest there's going to be more volatility into the future.